Gold exploding to $4,000 a troy ounce. Is it just wild hype? Or a very real possibility we should all be paying attention to right now? The question isn't just if gold will surge, but should you diversify your portfolio with it right now? Welcome back to Charles on Wall Street. Today we're diving deep into a fascinating and urgent question. Could gold truly hit $4,000? And what does that mean for your investments? The global economic landscape is incredibly unpredictable, facing inflation pressures and a stock market that feels shaky at best. This uncertainty is fueling what some are calling a new gold rush as investors seek stability. But is gold truly the safe haven we imagine? Or could chasing its potential gains be a risky gamble? We're going to explore this critical decision point for every savvy investor. Many are watching gold prices climb and wondering if they've missed the boat, or if the best is yet to come. The appeal of gold, a tangible asset with thousands of years of history as a store of value, is undeniable. It often shines brightest when other asset classes falter. This makes its potential move towards $4,000 not just a speculative headline, but a serious consideration for your financial future. We're living in a time when traditional investment strategies are being challenged daily. Understanding gold's role, both historically and in the current climate, is more important than ever before. Don't just react to the headlines. Understand the underlying forces at play. The idea of gold reaching such a significant price point is exciting, but it also prompts careful consideration. It's about more than just a number. It's about protecting and growing your wealth in an environment filled with unknowns. We'll break down the factors that could propel gold to these heights and, more importantly, discuss whether adding it to your portfolio is the right move for you. This isn't about chasing fads. It's about intelligent, forward-thinking financial planning. Let's be honest, many of us are constantly worried about our hard-earned money. We've seen market corrections, unexpected inflation spikes, and economic downturns that erode savings. This natural fear leads us to question the safety of our current investments. Gold has historically been a refuge during these turbulent times, a dependable asset when fiat currencies or stock markets become volatile. But here's the crucial point. Gold is not a magic bullet that guarantees immunity from all financial risks. While it's true that gold has often held its value, or even appreciated during periods of economic instability, it also comes with its own set of risks. Imagine pouring a significant portion of your savings into gold only for its price to crash. Or worse, buying right at the very peak of its cycle. This fear of missing out, or FOMO, can drive impulsive decisions that later lead to regret. Gold's value can fluctuate, sometimes quite dramatically, based on a complex interplay of global factors. Relying solely on its historical performance without understanding its current dynamics would be a misstep. There's a delicate balance to strike between leveraging gold's protective qualities and succumbing to speculative fervor. Many see gold as an insurance policy for their portfolio, a hedge against inflation and geopolitical uncertainty. Yet, like any insurance, you pay a premium, and its benefits are only realized under specific conditions. Ignoring potential downsides or over-allocating to a single asset class, even one as historically robust as gold, can expose you to unnecessary risk. Our goal here is to cut through the noise and provide a clear, balanced perspective. We want to empower you to make informed choices, not to simply follow the herd into a potential trap. Understanding these inherent conflicts is the first step towards prudent diversification. It's about acknowledging gold's strengths while respecting its limitations. This balanced view allows you to approach the $4,000 question with logic rather than pure emotion. We need to dissect the elements that truly drive gold's value and assess how they might play out in the coming years. The path to $4,000 for gold is paved with a complex, interconnected web of global factors. It's not a simple straight line. It's more like a multi-dimensional chess game. Geopolitical events, for example, frequently send gold prices soaring. Conflicts, political instability, and international tensions often drive investors towards gold as a universally accepted safe haven asset, creating immediate demand that pushes prices higher. The more uncertain the global political climate, the greater the potential for gold to appreciate. Then there's the monumental influence of the US dollar. Gold is typically priced in dollars, so when the dollar weakens against other major currencies, gold becomes relatively cheaper for international buyers, increasing demand and boosting its price. Conversely, a strong dollar can put downward pressure on gold. This inverse relationship is a critical dynamic to watch. Central bank actions also play a massive role. When central banks buy or sell large quantities of gold, or when they adjust interest rates and quantitative easing policies, they directly impact its perceived value and market liquidity. Their decisions can either provide strong support or create headwinds for gold prices. Furthermore, the fundamental principles of supply and demand are always at play. While gold is a finite resource, new discoveries and mining technologies can affect its supply simultaneously. Industrial demand, jewelry consumption, and investment demand all contribute to the demand side of the equation. A surge in any of these areas, especially investment demand driven by economic fear, can significantly impact prices. These interconnected factors create a constantly shifting landscape for gold investors. Trying to predict gold's trajectory requires a nuanced understanding of these various forces, each capable of influencing the others. Each of these elements contributes to the overall uncertainty surrounding gold's future price. How will geopolitical events unfold? What will central banks do next? Will the dollar weaken or strengthen significantly? These are not easy questions to answer, and their responses will ultimately dictate gold's journey. Before making any investment decisions, it is crucial to consider how these variables might converge and diverge. This multifaceted analysis is what separates informed investment from speculative betting. We aim to equip you with the knowledge to navigate these complexities. So back to our central question. Should you diversify now? The answer for many investors, particularly in the current economic climate, points to a clear yes, but with careful consideration. Gold offers unique benefits as a diversifier, primarily acting as a buffer against market volatility. When stock markets tumble and other assets lose value, gold often moves inversely, providing a crucial stabilizing force for your overall portfolio. This protective quality is why it's often considered a cornerstone of a well-balanced investment strategy, especially for those seeking to mitigate risk. Beyond its role in portfolio protection, gold also serves as a potent inflation hedge. When the purchasing power of fiat currencies erodes due to rising prices, gold has historically maintained its value and often increased in dollar terms. It acts as a real asset that is not subject to the same inflationary pressures as paper money. This characteristic makes it particularly appealing during periods like the one we are currently experiencing, where inflation remains a persistent concern. If gold were to hit $4,000, that would represent substantial profit potential for those who diversify before the major move, offering both protection and growth. Consider the scenario where traditional assets face significant headwinds. An allocation to gold could not only cushion the blow, but also provide a source of liquidity and potential gains. This isn't about abandoning other investments. It's about judiciously allocating a portion of your wealth to an asset that behaves differently when market conditions become challenging. By adding gold, you're not just hoping for a price surge, you're fundamentally enhancing your portfolio's resilience. It provides a strategic advantage in an unpredictable world, allowing you to ride out economic storms with greater confidence. Therefore, the decision to diversify with gold isn't solely about chasing a $4,000 target. It's about building a more robust and adaptive investment portfolio. It's about strategically positioning yourself to benefit from gold's unique properties, whether as a hedge against inflation, a safe haven during crises, or simply as another avenue for potential profit. Now, let's explore the practical ways you can actually gain exposure to this powerful asset. If you're ready to consider adding gold to your portfolio, you have several practical avenues for gaining exposure, each with its own advantages and disadvantages. The most direct approach is investing in physical gold. This includes purchasing gold bars or coins. The primary benefit of physical gold is tangible ownership. You literally hold the asset in your hand. This can provide immense psychological comfort and a sense of absolute control over your investment. However, physical gold also comes with considerations such as storage costs, insurance, and liquidity challenges if you need to sell quickly. It's a solid option for those prioritizing long-term holding and physical security. Another popular method is investing in gold exchange-traded funds, or gold ETFs. These funds trade on stock exchanges like regular stocks and aim to track the price of gold without requiring you to own the physical metal directly. ETFs offer excellent liquidity, allowing you to buy and sell easily throughout the trading day. However, with an ETF, you don't own the underlying physical gold. You own shares in a fund that holds gold. This introduces a layer of counterparty risk and typically involves management fees, which can eat into your returns over time. Finally, you can consider investing in gold mining stocks. This involves purchasing shares in companies that are involved in the exploration, extraction, and processing of gold. The advantage here is the potential for leveraged return. If the price of gold rises, mining companies' profits can increase disproportionately, leading to greater stock price appreciation. You also gain exposure to management expertise and operational efficiencies. However, mining stocks come with additional risks beyond just gold price fluctuations. These include operational risks, geopolitical risks in mining regions, environmental regulations, and company-specific issues. Their performance is also tied to the overall stock market. Each of these options offers a different risk-reward profile and suits different investor preferences. For instance, physical gold might appeal to those seeking maximum security and independence from financial institutions. Gold ETFs are ideal for investors who value liquidity and ease of access. Gold mining stocks could attract those looking for higher growth potential and who are comfortable with additional company-specific risks. Understanding these distinct methods is crucial for making an informed decision that aligns with your personal investment goals and risk tolerance. It's not about choosing the best option, but the best fit for you. As we wrap up, remember these critical takeaways for navigating the gold market. Thorough research is non-negotiable. Don't rely solely on headlines or speculation. Dive into the factors we've discussed, understand market dynamics, and truly grasp what drives gold prices. Always understand the risks involved with any investment. Gold, despite its reputation, is not without its own set of potential downsides, from price volatility to liquidity issues depending on your chosen investment method. Most importantly, always prioritize a diversified portfolio. Never put all your eggs in one basket, no matter how shiny that basket might seem. While we're discussing these powerful strategies, it's vital to state that I am not a financial advisor. This content is for educational purposes only and should not be considered personalized financial advice. Before making any significant investment decisions, please consult with a qualified financial professional who can assess your individual circumstances and provide tailored guidance. Their expertise is invaluable in creating a financial plan that's right for you. They can help you determine the appropriate allocation for gold within your unique portfolio. To help you continue your journey of informed investing, we've prepared a comprehensive, free guide. This guide delves deeper into the specifics of investing in gold and offers practical strategies for minimizing risk in your portfolio. You can find the link to download it in the description below this video. It's a valuable resource for anyone serious about understanding gold's role in their financial strategy. Don't miss out on this opportunity to arm yourself with more knowledge. If you found this discussion valuable and want to stay ahead of the curve in your investment journey, please take a moment to like this video. Your engagement helps us reach more people who can benefit from this kind of educational content. And, of course, hit that subscribe button to join our community. We regularly share insights, market analyses, and practical tips to help you build a more secure and prosperous financial future. Don't miss out on our upcoming videos that could significantly impact your investment decisions. Don't go anywhere yet. We've only scratched the surface today, and there's so much more to uncover about intelligent investing. In our very next video, we're going to tackle a critical topic: the biggest mistakes investors make with gold. You definitely don't want to miss that. Hit the subscribe button now and turn on notifications so you're the first to know when it drops.